This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Hello, Diana.
Hi, May.
So if you actually haven't looked at the trajectory of shares over the past 2 weeks, you might actually think that nothing has happened because we're actually right at the same level of the S&P 500 as 2 weeks ago. But if you actually do look at the momentum of shares, then we've actually seen a bit of a V-shape over the last 2 weeks. So last time we met on the podcast, Trump had just paused tariffs on Chinese goods coming into the US. That 145% tariff had just been paused. Everyone was very, very positive. And things kind of calmed down a little bit 2 weeks ago. That was until last week when Trump had another episode. He probably rolled his wheel of fortune every morning, and then last week, it landed on Europe. He started to say that he probably would put up tariffs on Europe again up to 50%. And he would also raise tariffs on all iPhones. So iPhones are not made in the US. They are mostly made in China. Some of them are made in India. He wants to bring iPhone production back into the US. So he would put up a 25% tariff on all iPhones not made in the US. So that kind of freaked out markets a little bit. But that was quite short-lived. By Monday this week, all the deals with all the hikes in tariffs with the EU is now paused until July. So that's the same with all the other pause in reciprocal tariffs. So markets calmed down a bit again. So it's been quite interesting so far.
Well, it's sort of a bit of the same, really. And we knew that these ups and downs in trade talks were going to happen. I suppose Trump and his team are getting a bit annoyed with Europe that they haven't come to the table around trade deals like we've seen with China, the UK, as well as some other countries. And the EU is one of the US's main trading partners. And they have been, sitting quite strongly in their opinion that they are going to tax US imports as well. I sort of just see this as more negotiations in the process. But in saying that, when we did the calculations around how much the average US tariff rate would rise with the EU tariffs, we went from a post-Liberation Day high of around 35% average US tariff rate. That's coming up from 3% before Trump was in power, up to about 35%, down to about 25% with some deals, then down to now about 14%, and now back up to around 20% or so with the EU tariff. So we're sort of bouncing around still at high levels. And I would have thought that markets would have been a bit more worried about it, but I guess that they're also seeing it as just more negotiation. And ultimately, I think the US does want to make a deal with its trade partners. So we will see some resolution. I think it's unlikely that EU tariffs are going to go up to 50% that would be quite negative both for the EU and for the US. I think that Europe will want to make a deal with the US. But in the meantime, of course, we probably are going to see markets bouncing around. And I guess in the short term, it comes down to if the hard data in the US and globally starts to soften in line with some of the weakness in the soft economic indicators that we've had, like consumer confidence, business confidence. If we start to see a further slowing in the jobs market or in growth indicators, that would probably see the next leg down in markets. But my view, and also I suppose the view of our team, is that we probably have seen the worst in terms of the biggest peak to trough fall in markets. We may get another 5 or 10% drawdown from here, but it's hard to see markets falling another 20% or so.
It still quite worries me a little bit, though, because there are a lot of countries on that list of reciprocal tariffs that Trump is trying to make a deal with. If everyone remembers the big board that he showed in the White House in April. And the clock is ticking until July. There's probably not enough time to make deals with all the countries. So I think one thing that we can probably be certain is that we'll definitely see more headlines coming out of the US over the next coming weeks ahead of the July 9th deadline. In the meantime, I do think that markets have moved quite quickly. So shares have basically recovered most of the losses since Liberation Day.
Yeah.
US shares are only now 3% down from its peak back in February, with Australian as well as European shares were actually even closer to the peak, obviously, because there's, I guess, less negative impact to our markets from all of these global trade wars. So I think that is saying to me that, shares are still in a pretty precarious position. They will probably be bracing for some more volatility to come.
And the increase in yields doesn't help the share market in the short term either. So we have seen quite large moves in long end bond yields across the world, particularly in the US. And that was really driven by concern around the fiscal position and concern that the US fiscal position is not sustainable. And the One Big Beautiful Bill Act, which we will get to. We have also seen yields move higher in other countries as well, like the UK and Japan. Australia has been a bit of an outlier because we have had a recent rate cut and the RBA sounded a bit dovish, so we haven't seen the same moves in long end yields. Shorter end yield, the 10-year, for example, hasn't moved as much as the long end, but I think the US is a little bit different here. And one potential positive impact to the economy from Trump reforms or changes is the potential tax reform that we're going to get, and it is very likely that we will see that. So that's in the form of this One Big Beautiful Bill Act, or UBA, as I like to call it. And that has now passed the House of Representatives. So it needs to pass the Senate now, and basically it is a form of tax cuts. It's the extension of the Tax Cuts and Jobs Act, which Trump put in place in his first term. Lower taxes on things like overtime, tips, state and local tax deductions as well. So it will provide a bit of a boost to the economy and, of course, increase the US debt position, potentially increase the deficit. You did some numbers on how much you think it's going to raise the deficit by.
Yes, so the US deficit numbers right now stands around 6.5% of GDP. And if you think how much the US grows each year, for example, real GDP between 2 and 3%, that 6.5% deficit is just going to add to debt every single year. And with the One Big Beautiful Bill Act, that's actually going to widen the deficit of the US fiscal position to probably above 7% over the next coming years. So that is telling us maybe we will have debt levels in the US reaching to above 150% of GDP over the next 10 years. That actually has worried markets quite a bit over the past few weeks. We've basically seen widening of yields in the 20 and 30 years between 90 basis points and 110 basis points. That's the highest we've seen since October 2023. So bond investors in particular seems to have maybe abandoned the US as a safe haven asset. So in times of volatility like this, you should be seeing investors flocking to buying long-term bonds as a safe haven asset. We haven't seen that this time. We have seen bond markets fleeing away from the US as well as fleeing away from the US dollar. And I think that's quite interesting because that does give a bit of questions about whether US is going to retain its superiority position among markets. What do you think about that?
I guess time will tell, and it depends on the further potential changes to policies from the Trump administration and whether they do retreat from some of the global organizations and trade blocs that we've been used to in the past few decades from the US, but that certainly appears to be the risk. And I suppose it also comes down to whether other currencies can take the spot of the US dollar. I'm just not so sure that, for example, the euro or the Swiss franc can actually take the spot of the US dollar as the reserve. But that certainly seems to be the risk that we're moving towards in the next few years.
Actually, another issue with this One Big Beautiful Bill Act, again, that's a mouthful, is that it probably makes it a bit harder for the Fed to cut this year as well. So when you have the government pumping in fiscal stimulus, that meaning they are running fiscal deficits while the economy is growing, then that basically makes it harder for the Fed to ease policy rates. Mm-hmm. So now basically markets are not pricing in any Fed rate cuts until at least September this year. Earlier, we were thinking that we would get something around June or July. So that basically has pushed bond yields up quite a bit as well. So Very different position versus Australia.
Well, quite different. In Australia, we've seen quite aggressive rate pricing in markets in the past few weeks, and that comes after the RBA meeting last week. The Reserve Bank cut interest rates by another 0.25%, so the cash rate's fallen from 4.1 to 3.85%. But it looks like we're going to get a series of rate cuts in the next year. Our own view at AMP is that we're going to get 3, could be potentially 4. We could get another rate cut at the next meeting, which will be in July. But on the day of the podcast recording, we actually had the April inflation data, or I should call it the monthly consumer price indicator. It's not actually the full set of inflation figures, which we know the monthly inflation data is not a complete reading of quarterly inflation because there's a lot of volatility, seasonal factors, and not everything is surveyed every single month. But nevertheless, we had the monthly inflation data coming out today. You wrote the note about it. So you are the expert. What did you make of the figures today?
So first of all, funny statistic, we've had 9 consecutive months of inflation within the target band. Again, inflation indicator in the target band. So our latest reading is 2.4%. That's basically smack bang in the middle of the RBA target band. So I think we should actually be celebrating. Things basically look quite good in Australia. Inflation in the target band, unemployment rate still quite low. We haven't seen a massive uptick compared to other countries. So that seems to be Goldilocks for the RBA. Of course, the details of the inflation reports, there are some worrying things in it. For example, egg prices, my favorite, is up.
Why are you so obsessed with eggs?
Because I'm the avocado toast generation, and you can't have good avocado toast without a poached egg. Anyway, egg prices up 18.6% over the year, basically up 4% over the last month maybe. There's some seasonal factors with Easter being in April this month as well. But that's quite massive. Fruit prices up a lot as well. And then besides that, you still have some sticky prices related to areas like health insurance, education prices, or tobacco prices.
Yeah.
So those are still pretty high. Overall, the numbers that the RBA cares a bit more about is probably not egg prices or tobacco or health insurance. Those are actually the trimmed mean measure. So that basically cuts out all the volatility, cuts out all the outsized outliers items in the CPI basket. Mm-hmm. And that trimmed mean indicators actually ticked up a little bit over the month to 2.8%. So again, that's still in the target.
That's 2.7
from 2.7% last month. Again, you shouldn't worry too much about it. It's still basically within the 2.23% target band by the RBA. But I think the RBA stance has been that they're quite concerned about inflation remaining in the middle of the target band, meaning around 2.5%. They actually were forecasting a second quarter trimmed mean measure of just 2.6%. So that 2.8% number is slightly above that. That might pose the risk for the RBA to move maybe a bit more gradual.
Yeah. So maybe we won't get the July rate cut. Markets, when I checked after the inflation data, they were about 59% priced for a July cut. So it's still a possibility, but I guess we need to see how the rest of the data comes until then. We get another CPI print, of course, so we can see how the data looks.
Yeah, that has come down from 65 or to 69% priced in after the RBA communications last week. They were quite dovish in their communications, so markets were thinking there's a very likely chance of a July rate cut. So that has come down a little bit. But then again, we shouldn't look too much into these egg prices or volatility because I think we've been misled by the monthly CPI indicator before.
Yeah.
Overall, I think what we should know is that things are still looking quite favorable here in Australia in terms of inflation landscape.
I mean, I tend to agree. The Reserve Bank has certainly run a bit of an experiment, if you want to call it that. Well, they've called that before in the last few years in terms of not hiking rates as much as some of our peers to preserve the gains in the labour market. And I think that it's worked out quite well. Yes, we have had some poor periods of GDP growth, but we haven't gone into an actual downright recession or a downturn. And of course, we still have quite a low unemployment rate. So we do expect some more rate cuts on the agenda, but they may not happen in consecutive months. So
Still fingers crossed for 3 more rate cuts this cycle.
which will be good news for mortgage holders. And that's it for today. Thank you, Me. See you next time.
Thank you, Diana.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.